I wanted to ask you about, and maybe you could cover what's called Irrevocable Life Insurance Trust. In the business,
Mm-hmm.
it's ILITs,
Sure.
ILIT, Irrevocable Life Insurance Trust.
Mm-hmm.
Can you explain to the listeners and viewers what that is,
Mm-hmm.
where that applies, and maybe if it makes sense for people to take a look at
Mm-hmm.
and get a quote?
Yeah. So what happens is an irrevocable life insurance trust, or ILIT, as you say the acronym is
Hmm.
exactly what that is to many people kind of scary. It's irrevocable. Once I create this, I can't get anything back.
Hmm.
Well, that's the whole idea. So because you can't get it back, so to speak, you really don't want this trust, in most cases, to own anything other than a life insurance policy. Now, why do you want an insurance trust to own a life insurance policy? Well, because anything you own or control is included in your taxable estate. So, to make life simple, if we have a net worth of zero, just to make it simple, except we own a life insurance policy on our life for $1 million, when we pass away, our taxable estate is worth $1 million. So, whatever the value of that life insurance policy that you own, it increases your taxable estate by that much, which could make you have to pay an estate tax. Well, what people will do is they will have this life insurance policy owned by a trust. When you die, you don't own the policy, the trust does. So that policy is now not included in your taxable estate. And so let's say that the beneficiary that you have is two children, right? Now they could own that policy themselves, and that would be out of your estate. But a lot of times we'll have a client say, well, you know what? It's not my two children that I'm worried about. It's who they married. Because when that policy pays out to them, I'm worried about their spouse getting their hands
Right.
on that money and dissipating it. So the life insurance policy held by the trust, when the insured passes, those proceeds pay to the trust. Then the trust has to dole out the money according to the terms of the trust, and so that's a layer of protection uh, to make sure, in certain instances, that that money doesn't get, lack of a better word, wasted, dissipated, et cetera. So that's one reason to have an insurance trust. The other reason is what happens when you have multiple beneficiaries. If you've got four, five, six, seven beneficiaries, children, grandchildren, a combination thereof, it then becomes kind of cumbersome to have a policy owned by one person and which is not the insured, and then have seven beneficiaries. Because if I've got a policy on my life and I name somebody else as the beneficiary that's not my spouse, it could possibly be subject to a gift tax. And that's another reason to have the policy owned by an insurance trust. Now, that's a whole different issue, and sometimes it will be and sometimes it won't be, so it's not in all cases. But what happens is you've got one person that's insured and you've got a couple of children, a couple of grandchildren, and maybe you write it so that you're going to cover grandchildren that you don't even know about because they haven't been born yet, right? So you could leave something, let's make life simple, and say you've got a son and a daughter, and you leave it to your son and your daughter 50-50 per stirpies. Well, what
Hmm.
does that mean? The 50% when you pass away goes to your son, the other 50% goes to your daughter. If one of them predeceases you, if it goes per stirpies, it still goes, let's say in this example, the son passed away, it goes to his family per stirpies or by stripes, which means it goes to his family equally. So you might have a son, he might have a son, a daughter, a wife, right? So they would
Hmm.
share in that. Or it would go per capita, which means if the son passes away first, then all of it goes to the daughter. This is all addressed in the trust. So these are the reasons to have a trust own that policy. Keep it out of your taxable estate, less
Hmm.
cumbersome on how those funds are dispersed, etc. So what you've got to be careful of is how much your premium is, because you have certain gifting limitations. And so the gifting limits are a function of how many beneficiaries there are, et cetera. So most of the time that's not uh, a problem, but it's still something that has to be considered and thought out. So that's why you would have a trust own the policy.
Hey, Stan the Annuity Man here. Did you like that little taste of my podcast, Fun with Annuities? Hey, if you want to see the full version, click the link and watch the whole darn thing. Remember, Fun with Annuities. Live in the reality, not the dream.